Albert, thank you so much for being here with us this morning. I'm incredibly excited for this episode. I know I say that about all of them, but this one in particular is going to be amazing because there's no one that I've known for longer as part of this Nexus journey, and that has had more visibility over the different steps, pivots, hurdles. So that visibility, as well as obviously your trust and inside scoop that you've had from being one of our angel investors, which I'm incredibly grateful for, paired with your absolutely amazing experience and slightly different perspective and way of going about things from a venture capital standpoint, which I believe to be disproportionately relevant for female founders and women's health founders, is why I know this is going to be an absolutely amazing conversation. So thank you so much for being here with us this morning. And please feel free to share with everyone how we've ended up here today and why you've built your company the way you have.
Wow, thank you very much for having me. So I started off as a ballet dancer. I trained at the Royal Ballet. I quit ballet. I only say that because people love to quote that about me. I feel like it's become like a defining characteristic of who I am, despite the fact I haven't done it since I was 15. I left ballet. I went into academia. I studied computer science and philosophy of science at university. I built multiple businesses and charities while at university. I did business strategy and public relations consultancy for deep tech and deep science businesses. And someone gave me £1 million when I was in my early 20s to start my first proper venture company. And I lost a lot of people's money. Freaking, I think, is the main learning. I lost a lot of money pretty quickly. I think in my career, I've lost over £14 million of other people's money, which is a very big learning curve. Throughout a decade of building startups, I built and sold 3. I was part of building dozens of others. I raised over 100 million in pre-Series A capital alone. I was appointed as the youngest ever member of the advisory board to HMRC. I judged the Great British Entrepreneur Awards. I ran events, parties, exhibitions, tech companies, services businesses. I made and lost money in pretty much every way you can possibly do that in the world of business. I worked in mid-market private equity on the sell side and advising on the buy side. I've done strategic acquisitions and many more things. And over that time, I learned a lot about how traditional services businesses work, how consultancies work, about how traditional financial businesses work, private equity, venture capital, about how startups are built, how built badly and well. And the trick is that not many are built well, perhaps none are built well in the traditional venture way, which I think is an interesting point to explore later. But throughout all of that, one of the things that I identified was money was not given to the right people, and the right reasons for getting money didn't really exist. And I started working with early stage founders and focused in on domain expert founders. And in a world of commoditized technology and AI, the only defensibility is tacit knowledge, domain expertise, and networks, because anyone can build a piece of software. And whether that's in women's health or in any other software-based industry, unless you are building significant deep tech hardware, which I think is on the edge of being changed as well, your defensibility is who you know and how you know it, because that gives you your edge. And what I realize is that domain experts are people who have resided in industry for a long time and disproportionately are not founders. They are not people that go out and ask for lots of money because they are used to being within a structure that doesn't kind of naturally beget that. They tend to be more risk averse. They tend to be more revenue focused. They tend to have families or mortgages or various other reasons that they couldn't just take someone's money and run at a problem for a year and be okay with failing. And that was the foundation of what turned into Tramlines. I started exploring this idea of domain expertise and how you could attach it to an engine that focused on revenue generation and early successful business building consistently, that created a platform for hypergrowth for a few, but actually created consistent success. And Tramlines that was born out of that really is just 4 things. It is domain expertise, which we seek externally. It is capital, which we provide through our fund and our network. It is a commercial engine, which we provide through our accelerator. And it is an innovation engine or a technology engine that we provide through our internal access to AI and technology expertise. You combine these 4 things together with a focus on early stage revenue and discipline, and you create incredible businesses quickly and effectively, some of which can go on to be amazing things. But what you realize is you can create successful businesses for much less capital. And the real key here is, and I go back to the point about financial products and consultancies, Consultancies work on time and materials, and financial products work on risk, basically selling risk across a portfolio. There is no format for compounding value creation from an early stage without the hybridization of the two models. So this idea of attaching equity to commercial incentives, aligning yourself with individual companies in a way that a consultant financial product hybrid would, allows you to have this disproportionate effort at earlier stages because you're participating in the value you're creating while also generating early revenue. And that was a very brief overview of a long journey, but that is a kind of basic understanding of what Tramlines is.
Yeah, and I absolutely love hearing that. Every time I hear it, it feels just, I get excited again because there's so many layers to that which are so prevalent to discuss across the whole VC landscape, but again, are disproportionately, relevant for women's health. One of which being just that domain expertise in women's health is often the researchers and the clinicians. And naturally, I think there's a lot of the types of skills that you build in that career, as well as the other barriers that you've mentioned there, that means that you're probably not going to run off and try to build a startup. But actually, they're definitely who we need building startups in the women's health space when we have this gender, data, research gap, et cetera, et cetera. So always so excited to unpack all of that with you, Albert. But I think to really just set the scene a little bit more, there's three things that we kind of need to cover, which is, the traditional model and overview. So I'd love for you just to explain everyone how VC actually works, because most founders that are trying to raise VC, I don't think they really understand the unit economics of it, and they're often learning it from VCs. So as a non-traditional VC, please feel free to explain for the founders listening how that model actually works.
So venture capital is a kind of an asset class of financial products that technically falls within private equity. You have a pot of capital that you invest in a collection of things that return on aggregate some sort of return. Now, the economics of that are actually incredibly simple. You charge a fee for the money that you manage, and you charge what's called carried interest, which is a participation in the upside that you create. So if you have a £10 million fund that charges a 2% management fee, that means for 10 years, which is the average life cycle of a VC fund, you have £10 million committed for 10 years, you charge 200k a year to manage that money. As that portfolio increases, you might charge more because the 2% of the portfolio increases. What does that mean? It means that every VC's baseline costs are covered by virtue of the money that they manage. Now, a £10 million fund is very small. A £100 million fund suddenly becomes £2 million of cost. Running a business for £2 million a year, guaranteed for 10 years, arguably quite an easy thing to do. Now, the second part is the carried interest piece, and only a very small number of people within a VC will participate in this. If you're a £100 million fund, you might have 2 or 3, 4, maximum 5 partners, I would say, who share in usually 20% or thereabouts of the upside. In other words, if that fund returns 100 million, which is a 90 million upside, 20% of that, 18 million, is given to the partners and distributed in whatever way the carried interest is shared. Now, what that means for a portfolio company, for a founder, you may have noticed I haven't mentioned them yet because they're not relevant to the pay structure of the VCs. So a VC's customer is an investor whom they're charging to manage their money, and they're charging on upside. The founder, or rather more accurately, the portfolio, are the product that they are managing, or rather they're selling to the LPs. The reason that that's important is, if you look at the economic incentives inside a VC, they're again very, very simple. You have your salary guaranteed for 10 years. So you have no interest in making sure short-term benefits happen. There is no interest in saving a company. There's no interest in any activity except for generating the largest long-term outcome, because your salary is guaranteed. If you're a partner, there's even less interest. So if you're talking to an analyst or an investor even, or whatever the titles are in the VC, they have no financial benefit from your success at all. Their salary is guaranteed. Their only benefit is in keeping their job and making money for their partners via carried interest. But carried interest happens on a portfolio on aggregate. Now, historically, we look at something called the power law mechanic, or the Pareto efficiency idea, which is that 80% of your money is returned by 20% of your actions. Now, in VC, it's more like 100% of your money is returned by 1% of your companies, or even 0.1% of your companies. If you look at like Andreessen Horowitz, who might invest in 10,000 companies, you could probably only name 10 of their super successes. And that's a really important factor here, because it is traditional VC belief that if you look at that form of efficiency and you you optimize for power law outcomes, what you want to be doing is betting on as many things that can be worth $1 billion in 10 years to pay out your fund times 10 in one company, and you invest in as many of them as possible, depending on how much money you have. Now, what kind of behavior does that kind of incentivize? Well, my salary is guaranteed, so I don't need to worry about the success of companies. The behavior that I'm incentivized to do is to invest in companies that will be worth $1 billion. If you're worth 10 million, 100 million, you don't really move the dial on my fund as a whole. So you're not that interesting to me. So what I want to do is I want to pump money in early so that you can start preparing for scale as soon as possible, so that if you fail, it doesn't matter. But if you do get towards scale, you're already ready to scale quickly, which means I'll make more money. And that's the kind of basic economics of VC. Now, I'm not going to start the denigration of that yet, but I think it's obvious to see, hopefully, just from a cursory thought process of how to build the foundations of a company, that building $1 billion company from day one might not be the best approach to building a business.
I love that. And the moving through the gears, and I've obviously I've read some things that you've written before about that are really, really resonate, and we'll get into that. I think two potential pushbacks I've heard people say on that is then, if a VC is looking to raise a new fund in less than 10 years and that reputation and carryover, and then in terms of smaller funds where they have less companies in their portfolio, each one maybe is more important to them from a reputational standpoint. Yeah. Any thoughts on that, if that is some pushback listening?
Absolutely. VC is great. It's produced amazing companies. But for a tiny percentage, for a founder, it's a terrible option. It is statistically an unlikely route to success. Now, I'm not saying the VC doesn't produce outsized returns, as is its ambition. It does. It has. But I'll give you another fact. 60% of European VCs return 1x after 10 years. 60% of the money invested, 60% of VCs nominal value, not aggregate value. 60% of VCs are returning the money their investors invested back to them after 10 years, not accounting for inflation or interest.
Yeah, so they've lost money.
They've lost a lot of money. And the reason I say that is, there's another really important actor here. The idea that if you invest in 100 companies, that one will be hyper successful is a kind of foundational basis of VC as a concept. In 10 years, the world will look different. We're going to make 100 bets of what it will look like in 10 years. One of them will be right, as far as I can tell, accidentally. And that is a really interesting concept that has worked historically and provided money. Now, the problem is, what are the leading factors of the companies that are successful? Well, the biggest leading factor is the leader's ability to continue to raise money to offset massive losses on hypergrowth curves, right? And I mean, a big failure of this one that people talk about a lot is WeWork, but WeWork does still exist and does still have market share, and it is now, I believe, a profitable company, although a very different company and a much smaller company than the one that it was. The point that I'm making is, investing in 100 horses, you might win one of the races and you might have outsized returns, and that in and of itself isn't a bad model if you're the person benefiting from it, i.e. the fund. But the big problem in that is that if you're not accessing, from the fund's perspective, if you're not accessing the best people who can raise the most money in the future, then your chances of success drop drastically. They don't go from 1 in 100 to 1 in 100, they go from 1 in 100 to 1 in 10,000. But if you're a smaller fund that can only invest in 100 things, the chance of your success becomes statistically unlikely. Now, there are examples of funds who are good pickers, but they tend to be funds that follow other funds or follow bigger access to money. But the key, and I think this is the most important part, is that the highest indicator of success is ability to access future capital from an early stage. If you're optimizing for accessing future capital, you're not optimizing for commercial networks, for understanding of the domain, of access to the right people. From a commercial perspective, you're doing it from a fundraising perspective. So I'm not saying that VC doesn't work. VC's great. I just don't want to be involved in it.
I love that. I think there's so much I'm really excited to get into, but I think just to really set the scene a little bit more before we do, I think it would be great to hear your thoughts on the current AI and health tech landscape. So I know you're on the HMRC advisory boards for that, and we've already touched on some really amazing things I want to circle back to, like how community is a form of defensibility and other forms of defensibility such as tech and regulation are maybe actually becoming reduced. So I think there's some really interesting threads we can pull on from how you see the current AI and health tech landscape, and then we'll take that into the bulk of the conversation.
There's so much to say on this. Okay, so I'm going to say two completely separate narratives. The first is AI is a useful tool. It isn't a product, right? And AI as a tool has made a bunch of jobs easier. And AI as a tool has drastically dropped the barrier to entry of a whole bunch of things like software development, like scientific research, like academic research. There's a whole bunch of things that you can now do, economic assessments or analysis. There's a whole bunch of things you can now do using AI as a tool that are easier. If you map out processes and you implement AI in those processes, you can increase the efficiency. So the ability for people to participate has drastically increased. Now, the biases of the data that underlie that is a whole separate question, but at its basis as a tool, it can make things easier to access and can make things more efficient. And in healthcare and health industries, that is even more true. If you are a clinician who doesn't know how to spin up a website or doesn't know how to create a business plan, suddenly some of the tools you might have had to pay for previously, you no longer have to pay for. Your limited knowledge is expanded by your ability to access the kind of general domain expertise of AI. That's not that interesting. It's cool, and it will proliferate a huge number of ideas being developed, but I think long-term is not that interesting. What is interesting is that the agentic future, if you will, is not about AI as a tool, but rather about the orchestration of AI infrastructure as a collaborative asset in value creation. What does that mean? It means that we think about hierarchical structures of people that sit on top of software infrastructure that's attached to a large portion of data. Most of that data is now in the cloud. Well, that's a kind of hierarchy with infrastructure, technology infrastructure, software underneath, and then data underneath that. But the future is hierarchical structures of agentic architecture that sit alongside you. And what that means is small numbers of domain experts, clinicians or other experts, are able to build out whole teams of value creators, not just of utilities, to participate in the creation of value that they are trying to create. So they're creating value alongside them. And this is a very quick explanation of quite a complex and long-term change. But I think what I'm seeing, or what I'd like to see more of, particularly in women's health or in health more generally, is that the application of AI as infrastructure rather than as a tool to improve the efficiency of tasks, that change will start to happen faster, which will unlock a lot more.
And Will, there's a really great thread there that I'm sure we'll end up coming back to when we touch on why you don't love the 0 to 1 approach, as you've already mentioned, in terms of your company's on day 0 and you're trying to reach $1 billion. And when I read your article on that, it just resonated so deeply with our own Nexus journey. So I know we're going to end up coming back to that. But just to kind of finish off setting the scene, I know you've alluded to little elements of your model and your approach, but now, yeah, feel free to just kind of talk us through Tramlines and why your model is different.
So a traditional venture capitalist makes money off carried interest and management fees, right? So the more you're able to invest, the more money you're able to generate as a salary or as salaries. The problem with that is it incentivizes the deployment of more capital earlier, and your product to LPs is risk, not anything else. Now, that's okay if you want to do that, but not what I enjoy and what I'm interested in. And then on the other side, you have consultancies who participate as a service provider for time and materials, where they are brought in to deliver a specific and discrete amount of value for a specific and discrete cost. The foundation of Tramlines was a hybridization of these two models, where we participate with each of the individual companies in our portfolio and align our incentives with them. So rather than it being about carried interest and management fees on our fund, which is very small intentionally because we want to invest less, not more, we want to be incentivized to invest less, our incentives are aligned on an individual company basis through retainers and commission and equity. Now, lots of people say, oh, but that means it's more expensive for startups. But what it actually means is with between 2 and 8 hours of delivery time with us a week, we are actually delivering revenue generative companies that we are participating in the value creation of. And then you have this secondary thing, which is, well, when we do need to raise money, it is as a deficit on an operating model that we truly believe in. And we are incentivized to do that in the best way humanly possible for the least amount of capital, rather than a traditional VC that would want to invest more and get it on that kind of roadmap. But at its core, what Tramlines is an accelerator, an operational partner that sits alongside founders or domain experts and helps them build their businesses. What it means is we are a revenue-focused, a revenue-first focused innovation engine to attach to domain expertise. Now, the final piece of puzzle I think is worth adding, or there's actually a few more pieces of the puzzle, but for the purpose of this is traditional VC optimizes ultimately for your ability to raise capital in the future to continue your journey, particularly at pre-Series A. So if they don't think you're able to raise capital in the future, then they won't invest in you. Now, I think that, I'll come back to that later actually. Think about that point. If you're really good at raising money, is that the same as being good at building a business? My view is absolutely not. What makes you good at building a business? Well, it's having a higher number of commercial connections. It's having a deeper understanding of the industry you're trying to approach. It's having a good understanding of the specific problems that you're trying to solve and how they might be solved and why people might receive them, or what procurement barriers you might have in trying to sell the solution to that industry, the idiosyncrasies of that relationship. Now, that requires you to have been inside that space for a long time. So where traditional VC goes, can you raise more capital and can you be that kind of visionary leader, of which 1 out of 100 might be successful? My view is, can you get to your first profitable business as quickly as possible? And at the core of the plans that we build out of this are, you have a minimum viable business, or an MVB, and a vision-based business. So everything we invest in, we still believe could be $1 billion, but we create a more tangible short-term plan for. And what comes out of that is very simple. Here is your 24-month or 12-month or 18-month roadmap to profitability, your minimum viable business, your first profitable business unit that tangibly proves all of the things you're trying to say, and also lays the foundation and the entry point for whatever it is you wish to do in the future. And what is your vision? What do you think it could look like in the long term? Now, if you ask any founder of any VC-backed startup whether their vision emulated what they thought it would be at the beginning, it doesn't. But if you haven't set up a kind of springboard from which you have some level of safety, then you fail. If you have, you're able to change and navigate. So rather than 1 in 100 winning, we have, let's say, 80% of them creating a business that creates some sort of liquidity and financial return for people, of which a further 10% become massive businesses because they find a way through the forest and become huge. And the final point that I'll make on that is, I don't think people should invest for diversity. I think that it creates a lot of risk if you try and disproportionately focus on a group of people. And I think there have been, after George Floyd in America, a lot of really damaging examples of VCs that wanted to invest in African Americans and had bad performance, and had nothing to do with the fact that African Americans are worse founders or business builders, but had everything to do with the fact that large pots of money got pointed at a much smaller group of people and a mandate that forced capital on businesses that might not have been ready, which created a horrible comm story about an incredibly positive thing. And it's not to say we shouldn't disproportionately focus on those groups in order to bring them into the conversation, because that we should do. But when I think about diversity, I think about the structural problems that disallow people access. And I'll just leave one kind of interesting survey that our director of networks and distribution, Erica Young, who has a long background in VC, sent to me. And it very simply said, if you take peers in an enterprise, a white man and a non-white man, the non-white man will have a higher number of commercially valuable connections on average than the white man. Now, the hypothesis is that they just had to have more conversations to get there. The white man, on average, will have higher level of access to capital, although disproportionately through friends and family. So the person who has a higher ability to raise capital has, on average, a lower number of commercial contacts. Now, if you remove the gender or ethnic diversity element of that, just as a statement, that is interesting. I would want to optimize for people that have a higher number of commercial relationships rather than somebody who's better at raising money. I can raise money. So if I focus on this group, I kind of accidentally become more diverse because it is a more diverse group, but I'm actually optimizing for the thing that makes them better at building businesses, not because they are a different diversity group. And that is like, it's not something that I believe in diversity and I'm really passionate about it, but at the same time, I'm looking at the structural things that create better businesses, which inevitably are more diverse because diversity of thought is inevitably a good thing.
That's really interesting. I've not heard of that study before. Do you know how they define commercial contacts? I mean, I can put it in the.
I actually don't, but I can get it sent so that we can actually look at it. But it is interesting. I think it was to do with the number of people inside their business and customers that they had relationships with. But I will find it and send it to you.
Yeah, I'd love to read that. So you've mentioned a few times now about this accessing future capital narrative and this kind of Series A. And this is something that I always found a little bit frustrating was you will literally get sometimes questions on application forms for VCs, right? Where it's like, what is your access to future capital? And I'd literally be like, there's obviously a lot of privilege in being a white English man, absolutely, but that's not the world that I grew up in terms of access to capital. It was single mum, dad left before I was born, council estate, on benefits, being told the government's evil and money is evil, which I don't entirely disagree with half of that statement, and I'll let people decide which half. But there was no access to future capital. It wasn't until you invested in us that I actually had a little something that I could put in that box in terms of access to future capital. And even then, right, it's a stretch on the narrative, and it feels like you're playing this quite inauthentic game. So for anyone that doesn't know, what we're doing with the podcast is obviously we've got a very consistent thread around the macro problem with all of the guests. And the report that I published in April, sharing our findings, I'm probably going to call it Moving Women's Health Along. How do we get from pre-seed to Series A? Because there is such a graveyard there. And I think thanks to the UK, whether that's SEIS, grants, friends and family, angel networks, sometimes you can raise that first bit of money, right? And or get to market now thanks to all the amazing software and tools that are available. And I think a really interesting question is actually, does VC need a rebrand? Or I guess you would probably say, no, it doesn't need a rebrand because it deserves to be frowned upon maybe. But I've done 7 calls with founders as part of this report in the last couple of days. Not a huge sample size, but all 7 had a very negative opinion about VC. And it wasn't the business model side of VC, because I don't think they actually really fully understood that, as I don't. It was more just about the fact that they had done lots of the online applications and never hear back. Or, friends have maybe raised VC, but then hadn't had a good experience, or whatever that might be. So I feel like VC is kind of looked on in a little bit of a negative light. And there are probably 5 components of the macro problem of moving from pre-seed to Series A around women's health that I think your approach kind of addresses. And normally I wouldn't run through so much in one go, but I really want to quickly cover these because I want to kind of really emphasize the thread between them, really hammer this point home. And then obviously I'm super curious to hear your thoughts in terms of like what really, jumps out and where you want to dive in. So one of the really important things to talk about is the censorship. So as many people will know, the censorship campaign has been proving that over the last couple of years, there's a lot of organic content that is censored. If it uses women's health words, Meta will ban ads. Banks actually won't let certain women's health companies open bank accounts because they think it's like, something weird or inappropriate, which just isn't true. So there's all of these additional barriers. Now, we know that maybe 25% of a seed round, maybe more in consumer, is going to be spent on growth and marketing. So if you have all of these extra barriers, you have a higher cost per acquisition, this is going to mean that you are in a less strong position to raise Series A, right? You're maybe going to take longer to find product market fit. You might have spent, more money, et cetera, et cetera. What that does is it then ties into the exit part of this conversation. So I actually, from a couple of VCs, said to me when we were in that process, we'd like to see a slide on your exit strategy. And my general understanding and consensus was that VCs at pre-seed don't ask about exit strategies because, what's the point, right? And what these VCs said to me was, because there hasn't been any Fintech exits, we'd like to see you do an exit slide. And whilst I don't agree that women's health or Femtech has less exit potential, ultimately there has obviously been less successful exits there. And subsequently, that hasn't really set that precedent that maybe VCs are looking for. So your approach in terms of raising less, getting to profitability, not only gives us more exit options, but it means that you maybe don't need to exit at all if you don't want further down the line because you still have majority control. And that control kind of brings us to the ethics and data. So again, as I know it's a huge conversation in the women's health space at the moment, especially in America, because there's been some very unfortunate situations regarding abortion and that being proved with a cycle tracker. And considering most VCs want European companies to have an American expansion plan, it means that this is very topical. And the one big women's health success story that we have in consumer femtech was founded by a couple of guys and lost the lawsuit to Meta because of what they did with data. So does your approach being more aligned with the VC, where the VC is on your team, if want for a better word, rather than actually productizing you for LPs, does that actually more align with the ethics side of this part of the problem? Because a lot of the time, women's health founders will talk about how they're struggling to pitch VCs future commercialization plans and strategies because there is that data component. And then we've got the gender alignment. So this is something that, again, I want to just make very clear that the macro problem here on raising VC for women is absolutely the bias and the access to capital. Me and Albert have done an event on that together. We've done events with the Invest in Women Task Force. That's absolutely the main bulk of this problem. However, I've heard a lot of very top prominent female VCs behind closed doors say that actually, because women are better with money and they're more realistic with money, both of which are good things, that actually sometimes shoots themselves in the foot a little bit when it comes to raising from VCs, because VCs want to see maybe more ambitious growth targets. They want to see more spend. So is the fact that women are actually often better with money and more realistic with money actually means that they're maybe not always, there isn't maybe that gender alignment. So I think that's really, really interesting. And then the last point is the depth versus the total addressable market. So I think most women's health founders that I chat to maybe don't know this because they aren't thinking about their total addressable market in the context of what a venture capitalist needs it to be, which is in the hundreds of millions at least, if not billions or tens of billions. And the problem with that is there's a lot of very prevalent women's health conditions that need to be addressed, but due to either education and awareness, VCs don't think the market is that big. For example, if I said to you what percentage of women experience pelvic floor dysfunction, the answer is 50%. Most people don't know that. 50% of women, 1 out of every 2, will experience some form of pelvic floor dysfunction over their life. That's 25% of the world's population, right? That's a huge addressable market. But VCs often don't know that. Or there are a lot of women's health problems that are incredibly important to solve, but they don't maybe have a huge TAM, and there isn't that future expansion narrative because we have that gender and research gap in terms of where could this drug or this medical device or this software, how could it move adjacently later to create a bigger TAM? So again, that really affects women's health founders. So I know there was a lot there, but I really wanted to set the scene for how I see these 5 synergistic parts of the problem for women's health founders, all of which don't massively align with the VC model, which is why I'm obviously really excited about your model, because I feel like there's more alignment between those 5 parts of the problem and how you go about VC. So Albert, you recently wrote a piece on the philosophy of science, and I'll let you, quote that and go into that because you'll do it better justice. But my question to you is, you said the revolutions were built on decades of incremental refinement. So if revolutions are built on decades of incremental refinement, but we are only a couple of decades into women being included in medical and health research, and we're a couple of years, not decades, we're a couple of years into women of different ethnic backgrounds being included in that research, then how can we create a revolution in women's health?
So let's start very simply by saying that that philosophy of science quote is in reference to a Kuhnian theory of the history of science, which is that you have what's called normal science and revolutionary science. And it's basically the attribution of one person revolutionizing something. When in reality, any modern historian of science will say, actually, it's much more incremental over time, but historically, we attribute these moments because it's easier to understand it. The reason that I think that's a really important point with regards to women's health is that traditional VC model is that visionary individuals transform industries and completely solve all the problems in those industries. And you very articulately shown that, well, that's impossible because there are so many problematic facets, so many problems in infrastructure that there's no platform to stand on. So no individual could do that. Now, what may happen is in 10 years' time, we attribute some, hopefully, some amazing woman in solving issues of pelvic floor, but actually it will be built on the pillars being structured underneath of all of those problems being sorted. So the key is that traditional venture assumes one amazing individual or a few amazing individuals can revolutionize something, and they can't. They can stand atop of all of the work that has been done before and take credit for revolutionizing it. But they themselves, and maybe they can commercially benefit from the revolution, but they themselves won't build the infrastructure behind it. That happens over a much larger data set of people doing a much larger data set of activities. So let's go back to the first thing you said, which was sometimes they can raise from family and friends. And this is a really interesting problem, the graveyard from pre-seed to Series A. And the reason that it exists is actually very simple. a very small number of companies are appropriate for VC. And the leading factors are ability to raise more money, ability to shoot for the moon from day one, which discounts a huge number of people who are just not willing to take that kind of absurd risk. Once you get to VC, the way that valuations work are you overvalue yourself to take enough capital to catch up with that valuation and exceed it. So if you value yourself at 8 million and you take 2 million, your post-money valuation of 10 million, you believe that 2 million will not only get you to 10, but push you to 30. Or perhaps it takes you to 20, but you take money at 50 because you think you can get to 100. In other words, you are always running at a deficit, right? So if you take angel money and kind of early friends and family angels money, it behaves in a totally different way. It behaves in a much more considered and strict way because these individuals do not have large portfolios upon which to base the same economics. They are aligning themselves with the company usually, or often, except for the small number of exception angels. Mostly they're saying, well, I'll give you a bit of money to get started, but it's not going to be enough money or enough time or enough insight or enough structure to get you to the step one of what VCs need, who need you to be shooting for 3 stages later and know what 10 stages later looks like and be ready to get on that treadmill. So a big part of that valley of death, as it is often called, is that you got money on a premise that didn't align with VC. I mean, if you ask most people, what do you need? It'll be more time. I just needed more time. And, the culture was changing and things were changing, but, well, you took enough money that you didn't have that time, but you had a valuation that you couldn't sustain. So that's the big problem in the first bit. The second bit you said was on censorship or censorship, which is a great campaign. And the role of censorship, and this is not just for women, this is also for queer people, LGBTQ plus community, it's also for sexual education, sexual health more broadly, it's also for drug education and drug rehabilitation. It's for lots of issues that are kind of blanketly seen by large technology firms as a bit too risky to get involved in, or we don't want to do porn, so anything that involves women we'll probably just ignore because, it might be porn. And that's obviously a ridiculous output. Now, I do not have a solution for that, but unfortunately, until as a society and culture, we really approach those problems in a meaningful way and unlock talking about real serious problems without aligning it to sexuality and being sexual or X-rated content. And my favorite example of this is if Meta identifies trans, or rather identifies trans as sexuality, which it isn't. It's to do with gender and identity. So by aligning it with sexuality, it immediately groups it in a different category of things, which it would like to censor, which is absurd. The fact that it censors sexuality is arguably so absurd as well. But that category, the lack of categorization is a big problem. So on censorship, like, I'm a man, I don't think I should be in any way prescriptive of that, but there is a huge social and cultural change that is required to allow us to talk about drugs, sex, and women's issues, as well as a myriad of other things in a way that is meaningful, helpful, and educational to young people. That was part 2. Part 3 was on exits. And I think the problem with exits, and this is a really important point, is that traditional VC looks at IPOs as exit. When you're aiming for $1 billion, you're aiming for an IPO. There are not that many liquidity events that happen above $1 billion. There are, but there's not that many. So your real route to that kind of liquidity is an IPO. And IPOs happen less and less frequently, but also more and more frequently, the democratization of technology allows for moderately sized businesses to build interesting propositions. But moderately sized businesses don't IPO, and moderately sized businesses don't sell for $1 billion. Moderately sized businesses sell into private equity or strategics. If you're a VC, that's an uninteresting endpoint. It is actually where the majority of your liquidity comes from in terms of the nominal value of companies, but not where the majority of your value comes from in terms of return. So if you cannot show me a path to IPO, if you cannot show me a path to a credible multi-billion-dollar exit, I'm not going to even start the journey with you. Now, you made a point about markets existing or not existing and the size of a TAM. From a VC's perspective, that is attributed by the amount of cash available in that industry to give to you when you sell your business. That is the only factor I'm ultimately interested in. So if that doesn't exist, I don't care how many women are in the world, because you can't monetize it for me as a fund who wants to sell your business one day. And that's a really important factor. So when I'm going into VC, I'm going, hey, I'm going to make you £1 billion and I know where that money's going to come from, or you know where that money's going to come from. Let's go. But actually, in the modern world where you have infrastructural problems that stop women's issues being worth $1 billion in an IPO, And where there are many credible routes to mid-market liquidity, but that's not interesting to VC. So even if you have a credible route to a 50 to 100 million pound exit, you are not a VC backable business. Now the question is, what are you? And the answer is, I believe until Tramlines came along, nothing. You can either bootstrap it and get really lucky, or you can go down the VC route and get really disappointed. The alternative has never really existed. You can't afford to hire consultants to help build your business. You can't afford to bring in the expertise that could build your business. And you're not interesting enough to the types of investors that exist in that space. So you're left in this kind of world where you have no access to anything. And what happens is you have friends and family who believe in your idea and see the scale of the problem, but are not necessarily financially analyzing the exit opportunity on a portfolio aggregate level. And so when you get to somebody that does, suddenly you're rejected despite having made loads of progress. And you're overvalued, so you can't really pull back from where you are because you don't have another way to go. And my whole ethos around that piece is, why don't we allow for more moderate value creation at an earlier stage, which can be accessing huge swathes of liquidity opportunity in the mid-market, which VCs just never looked for. And one of the key reasons VC can't look at it is, if you're overvaluing yourself at every investment in order to grow exponentially, it means you cannot sell yourself at any one of those levels. If I'm valuing myself at 50, but I could only sell to mid-market at 20, I cannot sell because my last investor that has a consent right and a liquidity preference would destroy my value and wouldn't let me if I tried to. So I can't go down that route. So there's a whole series of structural reasons why VC is not set up to invest in earlier, more immature markets, even if it's a cultural and societal reason that market's immature and not a real reason like there aren't enough women in the world. The next bit you talked about was data and ethics, I think, which is around, one, men running women's health tech businesses. Like, men should absolutely be supporting women's health tech business and should be building women's health tech businesses. But disproportionately, what I've seen is the ones that have got anywhere. I remember seeing a guy who was starting a kind of a nail salon business. And I was like, yeah, that's fine. That's not an inherently female thing. But at the same time, he talked completely about women spending on nails. And I was like, the only reason you're doing this business is because you have access to the capital to start this, rather than you have insight into the industry and the relationships. And it felt like very much the wrong reason to do it. And I think because VC puts a focus on what I said previously, it doesn't actually enable or allow women to get involved. The final thing you mentioned before you brought us onto Revolution was this idea that women are better with money. And I'll go back to my previous point. Women are not better with money. Men are not better at raising money. Society and culture has treated us in a certain way so that our behaviors change. Now, I'm sure there are many psychological, physiological, and medical arguments around how gender and hormone levels change behavioral attributes, and I'm sure that's a really interesting study. I have no idea about it, and I'm not going to speak on it. What I do know is, if you optimize towards different attributes, you get different people. If you optimize towards ability to raise capital on this accelerated route to IPO, you will disproportionately get men who have been told that they can, who have lower risk, who are not as focused on family and looking after family, and have access to more capital. Who you don't get, somewhat unsurprisingly, are women who are thinking about looking after their children or their potential of their future children, or have been told that they need to be more conservative, or have been told that they need to look after people at home throughout their whole education and throughout all of the advertising. And so understandably go, well, I want to build something a bit more sensible. I want to build something that's a little bit more discreet, a little bit more conscientious, which has nothing to do with their gender, but rather to do with their social position. Now, I might be wrong, and there's lots of other factors involved. But if you remove the gender piece of it and you go, how would I optimize for sensible business building? Well, I would find people who have a conservative idea of financing, who can balance risk with reward. Now, if I'm willing to lose 99 companies, the risk-reward profile is disproportionately ridiculous. And it happens to be that it's mostly a certain demographic of people that are willing to do that, who do not have factors that are risky in terms of failure. So when it comes to women are better at money and that's why we don't give them money, that's not true. There are a subset of people who are better at thinking about money. And by the way, that's the same as people in their 40s and 50s who are in the middle of their career and have great salaries. It's the same attribute. If you take domain expertise as what we focus on, which is a much more diverse group, people who are earning, let's say, 100 grand a year and have 2 children and a mortgage are much less likely to go, I'm going for it. I'm going to do or die. I'm going to build $1 billion business. They may, however, and this is what often happens in the British economy, spin out and create consultancies and services businesses. And they create really good freelance consulting and services businesses. But the idea of scalability, well, that's held in VC, that's held in technology, that's not accessible, but it is. And the whole thesis and foundation of Tramlines was, well, let's take the engines that you need to do that and apply it to the people that we think are best at doing it. So what do you need for a revolution? You need a lot of infrastructure to be built. You need a lot of people to be politically persuaded to be more inclusive. But most importantly, you need to build incentive models that exist within real commercial structures that already exist, that incentivize looking for the right kinds of people. And by the right kinds of people, I do not mean diversity, women, ethnic minorities. I mean people with the attributes of building good businesses who can create liquidity events for investors. And that ultimately, I think, what I'm really getting at is the revolution of female health tech will be born out of a change in incentives that align with real people making real money, but looking at different attributes in order to do that.
There's about 5 things I really want to get into from that with you, and I hope we have time for 2 of them. So the first one was the collaboration piece. What I was already aware of, but I think you may be even more aware of, is the need for collaboration, or at least everyone is going to come together and accumulate to solving this problem collectively. It's not going to be done individually. When we don't have a tissue level understanding of a lot of the diseases women face, and we're starting at absolute zero when it comes to druggable targets, you absolutely are going to have a hard time coming up with your TAM and where the future of this company might go. And as you've said, if you can't walk into a VC and tell them how they're going to make $1 billion, well, then that's just instantly a bit of a broken model, right? So my question is, when you raise VC, please correct me if I'm wrong, because I haven't raised multiple VC rounds, I've only raised a few $100K. There has to be an element of that in terms of your IP, your defensibility, right? Otherwise, that VC isn't gonna own it. So how do we deal with this need to work more collectively and collaboratively, maybe across startups and academia, but potentially that doesn't align with the commercial interests of VC in terms of that sole company owning the solution?
So I think one really important point is stop talking about VC. Like, I mean, if you're trying to raise VC money, statistically you've already failed. If you raise VC money, statistically you've already failed. So by looking for VC money, you're already in a group of people that are more likely to fail at getting money, because not many people get VC money, proportionate to the number of people that look for it. Once you get VC money, you're very unlikely to succeed. So if 1 in 100 VC-backed companies win, and 1 in 100 people that apply for VC win, and the numbers are much bigger than that, the chances of failure go up drastically. So let's take a step back a second, which is, how do you create something that is valuable and approach it in a valuable way? And when you need to have this point of collaboration. And what I would say is it is much more important to look at your commercially viable inroads, like where can I start to generate value as I build more long-term IP? Now, most IP is not very defensible, or almost all is not very defensible. It'll be copied, whether it's hardware, software, or medical at some point, unless you're big pharma. The chance of an individual accessing any of those industries in a meaningfully protected way is pretty slim. And VC will agree with that. Their point is to scale it so quickly, it's cheaper to buy it than to try and loss, right? But among other things. But what I think is really important is the way I would approach building a business, and the reason I say ignore VC for a second is, rather than thinking about how can I create a defensible piece of IP for VC, which I don't think I can, because IP, it's not just the IP that needs to be defensible, it's also the commerciality. How can I instead build a much more iterative step-by-step process of commercializing around the ideas that I have to create a foothold to generate IP, which will include lots of people, even if I'm the one that commercially benefits from it. And this is where the MVP versus vision comes into practice, which is like, most people have no idea what the long-term output of their product will be, particularly when generating novel IP. I have a problem that I want to solve. I want to know how to solve it. I don't know how I'm going to get there. What I do know is I can start to monetize that problem or things around that problem, adjacent things, and I will include people and create community around that. if you aim for the problem straight away, which is what VC would tell you to do, you need to have, as you say, a really clear point of defensibility and IP, which is almost impossible individually, and as a collaboration becomes more problematic because of shared ownership. But if you instead say, how can I monetize adjacent to that space? Because the person most likely to solve that problem is the person closest to it, who has the most commercial access to it. Those are the two criteria. And I think that's where I would start. And that allows you to collaborate and create information. But I understand that your wider point might have been that people don't talk to each other to create these ideas in a kind of philanthropic way. And I think that is a whole separate question.
Yeah, so I'd love to kind of split that into two then. So putting the exact specificity of the VC model aside, someone's listening to this, they've raised a little bit of money or they haven't, but they're thinking, I need to raise money. This isn't a bootstrappable business. It's hardware, or that it needs to be clinical trials, whatever it might be. And maybe they've gone, okay, sure, it's not going to be from VC. But they need to raise that capital, and there maybe therefore has constraints around the ability to collaborate or do things more collectively.
Yeah.
Do you have any thoughts on that?
Yeah, I do. Honestly and unfortunately, the ability to raise money is largely to do with who you know and how confident they are in you. And if you are somebody with an amazing idea and some amazing early data, you need to meet the right people at the right time and get quite lucky. And unfortunately, I think that's, I wish I could say this is how you do it, but I think the chance of you doing that are quite slim. What I think is much more realistic is, how would you build a £20 million business in that space? What would that be? And what would be the first steps you take to build that business? And so what I would recommend that people do is, if they have a business they think they need to raise a lot of money for, maybe go, well, actually, how can I build a meaningful business adjacent to that thing and start to create a real defensible moat of who I am as a business and safety in the amount of money I'm earning to try and approach that problem over a longer period of time. The sad truth is, this idea that random people are picked out because of their brilliant ideas and given loads of money is largely not true. There are some small examples of it, of exceptional people or exceptional luck. But the reality is, I think, if you're approaching it with, I need to raise £3 million to have a go at building this thing, the chances of you doing it are incredibly slim, and the chances of you being successful are incredibly slim. But if you go, I know I want to be in this sector, and I know there are these people who spend money in this sector who already spend pounds, and that's a key point. Asking people to spend new pounds is very hard, but saying there are already these pounds being spent in this sector, how can I get enough of those pounds that I could live as long as I wanted in trying to solve this problem? And once I've done that, how would I get enough new pounds to try and do the next thing? And unfortunately, that might mean you never get to build your amazing idea. Or it might mean that you have enough conversations and build enough confidence that you do get to build your amazing idea, but a bit slower than you'd hoped. And I think rushing to raise money just means that you're more likely to fail and more likely to find yourself in a position where you're then struggling.
Yeah, so to just set the scene for anyone that doesn't know as to why that really resonates with me, and the way I love how you wrote it in that article, is I'm 3 years into Nexus to get to this point. So in hindsight, the slower approach, focusing on foundations, if one for a better way of explaining it, and gradually moving through the gears, I probably would have been further along after 3 years than if I had taken the approach that I have done trying to raise venture capital. And the way you explained it, which I really liked, was kind of this idea of having to maybe be quite manually involved in your business and then gradually removing yourself over time. And the reason that really resonated with me, and I think it is really relevant for women's health, is, again, for anyone not aware, the narrative of the Nexus app, so obviously was the recreation of this personalization to your health and fitness approach, using the large language model that we built, which is a recreation of me and how I would work with you one-on-one. Now, I tried to remove all of me and was doing no revenue generation. And then there is an element of cash is oxygen, and I ran out of breath. But putting that to the side, in terms of this like layered approach to building the company, probably the biggest mistake I made was not continuing to work with female clients in a way where they were paying me to get results and feedback with the tech, and gradually removed myself over time. And just to really round that off, I speak to so many women's health founders that fall into a category where their background is either working direct to consumer, like I was as a pelvic floor physiotherapist or a nutritionist, or they don't work direct to consumer in terms of the consumer paying them. They are a doctor or a clinician or a researcher, but they absolutely could move slightly adjacently with the qualifications and experience they have and work exactly how I did, which is sell direct to consumer at £250 per month. And then all of a sudden you have all the flexibility of cash flow, but you have what you are.
So there's a really important point in this. VC optimizes for scalability and exit value. Exit value is in some way a multiple of what you've created, whether that's conceptually or actually in terms of your revenue. If you take the basic economics of a company, the gross margin of a technology product should be at least 80%, often higher than 90%. But the gross margin of a services business is often as low as 40%. If you're a consumer services business, it might be zero because you're taking 100% of the fee as salary, if you see what I mean. So from a VC perspective, I'm not interested in your services business. I'm interested in your tech business. And the behavior that has bred is people at the beginning of their journey going like this is what I'm building. This is what I'm building. And my whole attitude is, why? When we get to Series A and we've worked out we can do this, let's do this. Let's start here and then let's see how far we get. And if we only get here, we still might make 20, 50 million quid.
I'd like to be there right now versus where I actually am.
Right.
I would have liked to have landed there rather than here.
And I think that the whole Tramlines methodology, and actually if you rip out all of the rest of the incentives and Albert's arrogant nonsense, really all it is can we take processes that are done well and exist, and can we change them into what they will be in the future? And anywhere along this curve is still a good business. But if we get here, it's your VC backable business. And that we call them validation gateways. And the way that we start is market validation, which is there's a problem that exists, it's big enough, it's valuable enough. Product one validation, can you solve the problem in a non-scalable way? Commercial one validation, will someone pay for the solution to that problem? Product two validation, can you solve it in a scalable way, which is a slider between those two things? Number 5, commercial validation 2, can you sell the scalable solution? And that's actually where the greatest amount of failure happens. Most people can build an app or a piece of technology that does the thing they do. Will people actually pay for it and use it is a completely different question. I would love to pay Leo to be my coach, but I'm not going to pay for an app that coaches me. Like, that's a big cultural jump. And also the economics of it in terms of adoption and retention jump drastically. So the idea that the bit between the two is one step is completely bollocks. The final bit is, can I sell the scalable product in a scalable way to a market large enough to have a liquid exit over $1 billion? And if that isn't true, then it's not a VC business. But why wouldn't you do the first things in order to get there and have multiple opportunities to exit along the way or build great businesses? And that is the foundational principle that I think people should approach what they do with.
There are so many other directions I'd really love to explore with you on this, but I know we're nearly at time and I want to make sure there's plenty of time for you to round out with obviously where people can find out more about you, etc. But I definitely think this is a conversation that we will digest, get some questions and feedback on, and would absolutely love to pick up for a part 2, because you're really the only person I've properly explored more of a solution-based approach to this with. So there's a lot more threads I'd like to get into with you. But for this episode, because I know we're nearly at time and you've got an important meeting, is there anything that you feel like we haven't covered that you'd like to say, and where can people find out more about you, any of your resources, or if you'd like people to get in touch?
Get in touch with Leo, not me, because he knows everything I know, because I've told it all to him. He needs to talk to me. And hopefully I'll do more work with Leo in the future. And the stuff, I'm really keen to open up a one-to-many opportunity for the content that I have. I don't need more followers, but what I would probably leave with is building a business is really, really hard and lonely. And I would suggest that your best asset is always going to be the people that you surround yourself with. And surrounding yourself with people that make you feel good and support you is way more important than any other factor, because I would say 90% of what I do is failure, and hoping that the 10% is good and risk mitigated in some way. But building something is about taking lots and lots and lots of tiny steps with people that you want to take them with. And I think that's the way you should approach that.
I absolutely love that. And yeah, not to kind of go too far into those next steps now, but obviously hopefully what we will be working on maybe collectively is that collaborative approach, because I think the water cooler culture is one big thing missing in startups in general, right? There's 1 to 3 of you in the company. But again, when we have all of this amazing domain expertise in women's health, I think bringing that together over kind of a 9-month program will be really, really exciting. So keep your eyes peeled if I'm able to pull that off in the coming couple of months. But yeah, Albert, thank you so much for being here today. I always love chatting with you. And yeah, I'm really excited to listen to that back, to be honest, and digest it again. And I really hope we can obviously do a follow-up and continue to work together more closely on this. So thank you so much for your time.
Thank you very much. Have a lovely day.